For decades, conventional wisdom has always dictated a single, overriding priority for any new enterprise: maximize absolute profit. Management consultant Peter Drucker offered a sharp correction to that idea. To him, profit is a secondary concern. Survival requires cash flow. This distinction creates a paradox that regularly wipes out unobservant investors. A company can legally report record-breaking profits while simultaneously going bankrupt. Every business exists in two separate realities at once. There is the story management tells the public, and there is the actual money resting in the corporate bank accounts. This chart illustrates that detachment perfectly. We see paper earnings surging, while actual liquidity disappears. Finding the ground truth behind those paper numbers is the primary task of financial forensics. Out of the three essential financial statements, the income statement and the balance sheet are constructed using accrual accounting and strict revenue recognition rules. Those rules rely on subjective management estimates rather than hard cash exchanges. Executives can stretch depreciation schedules on heavy equipment, reducing daily paper expenses to look highly profitable. They can also artificially lower bad debt allowances, masking the true risk of outstanding invoices. The cash flow statement strips away that subjectivity. It tracks the objective reality of cleared banking transactions. Analysts look for a specific diagnostic signal to catch manipulation: the mismatch between cash flow from operations and EBITDA. Because accrual rules are pliable, analyzing the gap between those estimated earnings and real cash cuts directly through the accounting fiction. This dashboard shows the baseline for a healthy, stable business. Cash flow from operations and EBITDA track closely together. A sustained, widening gap between these two metrics immediately signals underlying operational stress or active manipulation. The first mechanism that forces this gap open is an inflation in receivables. Selling aggressively on credit allows a company to book immediate revenue without collecting a single dollar. If the company faces defaults, that cash never materializes. This falsely inflates EBITDA, while real cash lags behind. A spike in credit sales without matched cash collection indicates hollow, unsustainable growth. The second vector of mismatch is a massive buildup in inventory levels. Reckless overproduction or slowing consumer demand ties up significant amounts of operating capital. Money has already left the bank to pay for manufacturing. The income statement delays recognizing this massive cost until those units are actually sold. This creates a severe time delay between the depletion of cash and reported profit reduction. Unchecked inventory growth destroys a company's liquidity while leaving its paper profits looking completely pristine. The third vector is intense pressure from accounts payable. This occurs when a company is forced to pay its suppliers much faster than historical averages. Suppliers tighten these credit terms when they lose trust in a company's solvency, demanding immediate payment. This dynamic instantly drains operating cash flow. The smooth expense recognition on the P&L completely masks this sudden liquidity crisis. That brings us to the fourth and most blatant factor of financial manipulation: aggressive revenue recognition. Management achieves this by prematurely booking future or entirely unearned revenue to meet current quarterly targets. The immediate effect is a massive artificial spike in EBITDA that looks excellent to casual investors. Instantly cross-checking that profit spike against actual bank deposits reveals the entire fiction. These four vectors are the mechanical levers management uses to detach paper profits from operational reality. The income statement and the balance sheet represent a carefully curated narrative, not an undeniable, strict mathematical reality. Legal accrual loopholes provide management the exact flexibility they need to craft that subjective story. This is why forensic accounting relies on a singular truth: cash is noble. Cash flows involve real money entering or leaving a company, which means they are entirely verifiable. This diagnostic framework brings all four vectors: receivables, inventory, payables, and revenue together to form a complete picture. The fluid income statement is finally anchored and weighed down by the heavy reality of actual cash. The ultimate practitioner's rule is simple: never accept an EBITDA figure in a vacuum. Always verify proclaimed profit metrics against the objective reality of the bank account. While accounting rules are explicitly designed to allow for flexibility, cleared banking transactions offer the only undeniable truth.